Ladies and gentlemen, good day and welcome to Laurus Labs Limited Q1 FY23 earnings conference call hosted by Antique Stock Broking Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Monish Shah from Antique Stock Broking. Thank you, and over to you, Mr. Shah.
Thank you, Neera. Good morning and welcome to Laurus's Q1 FY23 results conference call. We thank the management for giving us the opportunity to host this call. Today we have with us Dr. Satyanarayana Chava, founder and CEO, Mr. V.V. Ravi Kumar, Executive Director and CFO, and Mr. Vivek Kumar from the Investor Relations team. I would like to hand the call over to Dr. Satya for his opening comments. Thank you, and over to you, sir.
Thank you, Monish, for this introduction. Thank you for joining us for our Q1 FY23 results conference call. Since COVID-19 continued to pose challenges with increased infections with new sub-variants, we hope every one of you and your family members, colleagues, and friends are keeping safe and healthy during these challenging times. We are pleased to have this opportunity to update you on the progress and answer your questions. Our Q1 results reflects a very healthy start for our FY23. As we continue to improve on product mix, and EBITDA was maintained at 30%. This was achieved despite ongoing disruption in the business environment due to COVID-19 and geopolitical scenario. Our CDMO division delivered exceptionally good performance, offsetting pressure on our ARV business. And growth in the API division was modest, but future business prospects appear very encouraging. Imported RM prices have largely remained elevated in the light of supply chain conditions, but we do anticipate some of these challenges to abate with gradual China lifting sanctions during COVID, and also easing of geopolitical situations across the globe. We are progressively expanding our portfolio and new initiatives. This, along with our significant investment program, should enable us to capture exciting and new business opportunities and reduce any concentration risk from a single product or a single therapy, and deliver a broad-based sustainable growth in the long run. As a result, we retain our aspirational target of a billion sales, and which will be partially supported by several approvals anticipated. Moving on to our financial results for the quarter, we achieved 1,539 crore in revenues, showcasing a very healthy growth of 20% year-on-year. Sequentially, we have substantially improved on our non-ARV revenue numbers. Formulations reported a revenue of 349 crores for the quarter, a decline of 33% year-on-year. Coming to LMIC business, while broader demand environment in ARV was softer, the pricing has largely remained depressed in Q1, which is at already record low levels. We are taking a calibrated bidding approach to ensure better outcomes in the tenders for this business. Having said that, we are very confident of sustaining our leadership position in the ARV first-line treatment, both APIs and formulations. During Q1, we launched Lopi-Rito combination in US. Additionally, we are awaiting few more approvals in the US, which will drive our growth in the coming quarters and years. As you're aware, Laurus is a fully integrated player in ARV formulations, and we believe we have the fair ability to weather pricing challenges, and we are able to maintain our margins in the current quarter, supported by performance in our divisions. Coming to the developed market, our performance was stable as increase in the generic volumes more than offset by pricing pressure. We continue to leverage our front-end operations in U.S. market for new product launches. During the quarter, we filed one additional ANDA and received two approvals, both tentative. We expect U.S. filing pace to pick up during this financial year. Cumulatively, we have filed 32 ANDAs to date, of which we have a total 11 final approvals and 14 tentative approvals so far. In Canada, we continue to have 11 product approvals, of which we have launched 5 products and planning to launch more products in the next couple of quarters. For EU markets, we have validated 2 products as part of the CMO opportunity. We expect a significant upside in this financial year from these products, and we have a basket of 9 approved products, of which we have launched 3 on our own label, and we will be launching 2 more products shortly. Based on our healthy product pipeline progress, we continue to invest in non-ARV FDF infrastructure. As indicated in our last conference call, we have commissioned our brownfield expansion at Unit 2, taking the total FDF capacity to 10 billion units now. We expect a more gradual ramp-up of capacity utilization in the new block. On the R&D front, we continue to allocate critical resources to our research initiatives and invest in portfolio with product-specific approach based on complexity and scale economies. Additionally, we are implementing steps to bring more robustness in our overall product development processes, including focus on bringing digital transformation within the organization. We are happy to share that we have commissioned our sterile R&D labs, which we have started working on a few priority projects. Overall R&D spending to sales for the quarter was at 3%. We have a total 55 products in the R&D pipeline, either under review or under development, having an addressable market size of over 40 billion. When it comes to generic APIs, our antiviral business during the quarter continued to witness sequential improvement and sales grew to 383 crores. While overall demand environment stays faster, we expect volume and prices are going to stabilize around these levels. We continue to maintain a leading market share in current product line and also expect to increase marginally in the developed market supplies of APIs. Onco APIs reported 62 crore sales during this quarter, reflecting a marginal growth of 5% year-on-year. As we are mentioning, we have the largest high-potent capabilities in the country, and we are adding new capacity, and we continue to see good uptake in Onco APIs. Our aim is to strengthen global leadership in offering Onco APIs not for generic customers, but also for the innovative clinical phase molecule also. APIs other than oncology and ARV sales, including diabetes, cardiovascular, and asthma, showed very good numbers for the quarter at 138 crores, growing significantly at almost 80% year-on-year. This was supported by new contract supplies, and we believe this segment should return to healthy growth trajectory.
expenses. I would like to understand, whether this, run rate is sustainable, going forward. I'm not necessarily looking at quarter to quarter, but directionally. And is there any kind of a one-off supplies where we have ceded to any of the contracts which might not recur probably going forward?
I will answer this question in two parts. You are mentioning on two contracts, two pieces of information. One is multi-year, multi-product contract signed with the Global Life Science Company. We are building a dedicated capacity to cater to the products and demands as per the contract. Right now, we are developing products which will go into that manufacturing site, and one NCE validation is going on in our current site. So the revenue coming from that contract is not that significant right now, but it will become significant once we qualify the plant, which will happen maybe second half of next financial year. That's a question about part one of your question. In the part two, which we indicated, we got a major contract from another life science company, and the supplies are ongoing. So with that, there is no one-off in Q1.
And this will continue probably for the next year. It's a longer-term contract. It's not necessarily a short-term contract.
These clinical programs, commercial, see, it's difficult to predict. I think only, as I mentioned in our last call, numbers only will tell you how we are doing. Yeah.
And the run rate should continue. More or less directionally, we should continue to do well on the CDMO part. Is that right assumption, sir?
We will do very well in the CDMO part, that's for sure. So a lot of opportunities ahead of us. We are, as Mr. Ravi mentioned, we are creating 3 new greenfield sites for the CDMO division. That indicates how much of opportunities are in front of us.
Thanks a lot. And so one question, last question from my side is on the formulation side. We have the new capacity coming in, but on a quarter-on-quarter, we have seen a dip. From a run rate that we usually do. Do we see the run rate kind of moving ahead, and when do we start to optimally utilize the capacity, sir? Some color on how we look at it directionally.
You are asking formulations. Formulation capacity is fully qualified right now, but it will be fully utilized by end of this calendar year.
Sure. Thanks a lot, sir. I'll join back to you.
Thank you. Next question is from the line of Krish Mehta from Anam Holdings. Please go ahead.
Hi. Thank you for taking my question and congratulations on a good set of numbers. The only question I had was on the total breakup of ARV versus non-ARV sales for this quarter.
The ARV APIs is at 25% of our sales. If you recall, ARV APIs, once upon a time in 4 or 5 years back, used to constitute 80% of our sales. Now, it is 25% of our sales, and 17% of sales came from ARV formulations. If you sum it up, about 42% of our sale came from ARVs, either APIs or formulations put together.
Okay, thank you so much.
Thank you. Next question is from the line of Amey Chalke from Haitong Securities. Please go ahead.
Thank you for taking my question, and congratulations to the management for the good set of numbers. Sir, I have one question on the margin side. So despite this sizable increase in the synthesis business, our margin improvement sequentially has been minimal. So is it fair to assume that the synthesis margins are not very far from the company level margins? And if it is so, don't you think it is on the lower side? If you can clarify on that. Along with that, also, if you can explain the higher other expenses for this quarter compared to the 4Q of last year.
There was price pressure on ARVs, both APIs and formulations. The reduction in the margins in ARVs was offset by higher margin CDMO business. The CDMO business, the numbers are on par with any other CDMO focused player. That is one. Second, when it comes to the other businesses, we are talking about EBITDA. EBITDA numbers, for the entire company, we are not disclosing the division-wise.
Expenses.
Yeah. So, and other operating expenses, I will ask Ravi to clarify.
Yeah, the expenses side, there is a power shortage in our manufacturing area in Andhra Pradesh in the last quarter. We have sourced a lot of power from the private sources, and also we use the diesel. We spend about 33 crores additional expenditure towards power. And some part of the foreign exchange loss also there. You are aware the foreign exchange loss on account of the not incurred loss, it is an restated loss. So that's also reflected in the other expenses.
Sure. So going ahead, you expect these other expenses to normalize, at least in the near term?
We expect so. The power and fuel is getting normalized already.
Okay. And if the GM remain at the similar level because of good business mix, don't you think the EBITDA margin has scope to improve going ahead?
Our overall for the year, we gave an EBITDA margin guidance of around 30%, and then we are still reiterating that.
Sure. Sure. And just last question I have on the formulation sales drop. On the TLD side, how do you see the tenders going ahead? And is the demand have gone down or the pricing has gone down substantially? That's why the market size has shrunk. If you can elaborate on this.
The volume front, there is no degrowth. Volume uptake remain robust for all players put together. In the last quarter, the most of the tenders, except South Africa, winner takes all tenders. So business drifted to few players rather than spread across several players. That's the case with the Global Fund and PEPFAR, where the volume split is evenly across all the players. So we do expect the supplies to Global Fund and PEPFAR will start from Q2. So we do hope the formulation sales in the ARV segment will pick up from the next quarter.
Thank you, sir. Thank you for taking my question.
Thank you.
Thank you. Next question is from the line of Nikhil Mathur from HDFC Mutual Fund. Please go ahead.
Yeah, hi, good morning. I hope I'm audible properly. There are 2 or 3 questions I had. The first question is on the capex for FY 23-24. We have guided towards 2,000 crores of capex. Can you help me with the capex which will be dedicated for the custom synthesis business in this 2,000 crores?
The capex number guided by Ravi little while ago is 2,000 crore for FY 23 and 24. I would say 40 to 50% of the capex is in the CDMO space. Either R&D or manufacturing put together is about that number. And very little is going into, actually not little, but nothing is going into the ARV APIs or formulations. Most of the remaining capex, say, which is around another 1,000 crores, is going into non-ARV APIs and non-ARV formulations or backward integrations.
Right, sir. us to continue to grow in this particular business? I mean, maybe one or two case studies that you might want to share from your broad portfolio of products in this business.
It's a very interesting question. We have added significant capabilities apart from significant reactor volume. So the company is in a position to do hydrogenations at very scale, low cryogenic reactions at scale, biocatalysis at scale, continuous flow reactions at scale. So company added significant capabilities. That is the reason we were able to attract, retain new customers, and in-source several products at late stage clinical phase or commercial because of our new enhanced capabilities in the company.
Right. And then just, if I may just squeeze in one final one. For Laurus Bio, can you share some outlook from a 2 to 3 year perspective? What kind of revenue potential we should expect from this business?
Laurus Bio, we did 30 crore sale in this quarter, and Q2 will be similar. Q3, Q4, we expect debottlenecking of downstream processing will be over, so some increase in revenues will come. But FY24 is going to be a flat year for Bio because our capacities are fully utilized by end of this year. That is the reason we are investing significantly, or we are planning to invest significantly in the division. And those capacities will come for commercial use in FY25. So FY25 is a big leap for Bio, but not FY24.
Got it, sir. Very clear. Thanks a lot.
Thank you.
Thank you. Next question is from the line of Binu from InCred Capital. Please go ahead.
Hi. Good morning, all, and congrats for a great set of numbers. Dr. Chava, your guidance of $1 billion for the year implies 50 to 60% plus kind of growth for the year. And in the first quarter, you have done 20%. So, which means for the next 3 quarters, you are looking at maybe 70% odd kind of growth in revenues YOY. Still that instills confidence, or is it more aspirational? How confident are you about meeting or surpassing that?
When we announced our goal, aspiration to become $1 billion, the dollar was at 73 rupees. Yeah, 70 to 73 rupees. So we are very confident to achieve that number now. Yeah. So at that number, I think we have every arms and ammunition available to reach there. Yeah.
Sounds great. Just to understand, is there any one risk that you don't need to say what it is, but is there that one risk in your mind which could impact achieving this, maybe some product, developing some problem, or one client moving away from you? Is there one or two such key risks which can impact this, or is it a well-distributed business target?
See, we have capacities, we have customers, we have visibility of orders, and except one product approval in formulations, all are in place. If we are scouting for a customer, we are scouting for a capacity or a facility approval and all, it is a long goal. So we are not that. We are very close to our goal. We have all the actions required, our abilities required to reach that number.
Great. Thank you, and best wishes.
Thank you. Next question is from the line of Tushar Manudhane from Motilal Oswal. Please go ahead.
Thanks for the opportunity. First, on this brownfield capacity, which is now come up in July. So, what could be the incremental operational cost associated with this, which will come in the subsequent quarters?
See, our formulations expansion capacity is fully manned. So those expenditures are already built in Q1 itself. So we are going to recruit marginally more people in new block, but those costs are already built in Q1. If there is a slight increase, it will be built in Q2. See, you are aware all these pre-operative expenditures are expensed, not capitalized in the company. So all those are built in our numbers.
Interesting. And just on other API segments where we have seen good traction over past few quarters. So how do you see this in terms of the new products and or the market share gain in the existing products? The perspective here is that there has been good amount of inventory-led disruption in API industry per se, maybe on account of COVID and or maybe the China-related lockdown. So how do you see the prospects for non-ARV API business?
Non-ARV APIs will continue to grow. And our increase in our inventory is a conscious decision we took to weather the challenges, supply chain challenges. So, in one way, our increase in inventory helped us to sustain our growth. So, if we are very prudent in our inventory, we might have challenges also. So, higher inventory helped us to sustain the supplies to our partners during challenging times.
Got it. Thank you. That's it from me. Thank you.
Thank you. Next question is from the line of Ritesh Rathod from Nippon India Mutual Fund. Please go ahead.
Yeah, hi. Can you quantify in terms of ARV pricing pressure, which you mentioned significantly, how much it would be down on a year-on-year basis?
It is both ARV, APS and formulation, if you take together, as I mentioned, it is about 550 crores. The margin impact was almost 15%, I would say. Yeah. The average 15% both put together.
Okay. And in case of custom synthesis, you spoke about 2 contracts and the second one where you are ramping up. So I presume you would have ramped up in Q1 as well as in Q4 to some extent. How sustainable that business would be after a year or so once it reached to a steady state? You see any sort of risk over there after a year or so?
These products are in the late stage or just launched. So they have a very long patent life. So these are not like generic molecules today. Company will A get market share tomorrow, company B get market share. Then we are not with the A and B, then we have no orders. But the NC is these innovators will have long rope. So I don't think these will vanish in a year. So these are pretty long term in nature.
This you are talking about the commercialized product, right?
Yes.
Okay. And any kind of pricing pressure comes in this product on an annual basis or productivity benefits which needs to be passed on?
We haven't seen significant price pressure in this division. commercial products, actually 7, 4 intermediates and 3 APIs.
Okay. And sir, and how many late-stage products would we have that can get commercialized over the next 2 to 3 years?
We don't want to give you a number, but there are very good number of candidates in the late stage.
And sir, on the current revenue,
That's because of those only we are expanding our capacities and capabilities in the division.
No, absolutely, sir. I was just curious, rest of the 7 that we have, do we see this number going 2x, 3x over the next 3 to 5 years? 3 years rather?
We don't want to comment on that.
Fair enough, sir. And sir, is there can you help us also with a split which is there between the business, between say contract research and contract manufacturing in the CDMO business, the early stage contract research that you do?
So we don't do any preclinical work. So we don't do any medchem work. So all or most, I would say, most of our revenue coming from manufacturing only. So nothing is coming from research. We don't have any FTE programs.
Right. So I mean, in terms of, is there a work that you're doing with the innovators during the clinical trial phase, maybe doing pilot quantities and all in phase 2, phase 3?
Yeah. Okay. Going back to your question, we do a lot of programs coming from phase 1, phase 2, but phase 1 revenues are not that big to mention. Yeah.
Right. And so secondly, on the formulation business, so how do we see the XR-ARV business in the formulations over the next couple of years? What would be the drivers for this business? Excluding
So a lot of filings done, a lot of approvals anticipated, and the growth in formulations will come from non-ARV now onwards.
Okay. So you mentioned a specific product around in Europe that will be a big driver. By when will that product start to kick in for this?
Partly this quarter, but majority will come from next quarter onwards.
Okay. And then lastly, on the capex, you talked about 1,000 odd crores on the non-CDMO part of the business roughly. Can you just help us understand what were the areas where you're investing these, where the primary areas investment in on the XARV side for the CDMO for the capex?
In the non-ARV, non-CDMO capex, maybe 2/3 is going into APIs and 1/3 may go into formulations further.
Okay. And the formulation, we adding more capacity beyond the brownfield that we've done, we've commissioned this quarter?
Not this financial year, but next financial year maybe, yes.
Okay. Thank you.
Thank you. The next question is from the line of Siddhartha from the Investment Trust of India. Please go ahead.
Hello.
Yeah.
Yes, sir. So, sir, I had a couple of questions. One on the ARV tender side. So, sir, 3 years ago, we received a large multi-year contract for the LMIC market. Just wanted to understand when is this due for renewal? Is this done, the new round of tender for this?
The South African tender results were announced. We don't have any formulation say there. So API sales will go to South African contract. And the Global Fund and other tenders will be announced soon for 2023 onwards. So for 2023, allocations were already made and supplies will start from next quarter.
Okay. Sir, my second question is on the large CDMO product. Is it fair to say that if you exclude this from this quarter, then the synthesis business is flat to single-digit growth on a YOY basis?
Large multi-year, multi-product contract hasn't given any significant revenues in Q1.
Now I'm talking about the commercialized large contract that we have been supplying since March.
No, still there is growth. So, and this is not a 1 month contract. So the contract still we need to execute, fully.
So basically the follow-up to this is that is this contract a multi-year contract or it's a renegotiable, renewable, single year kind sort of a contract?
I think it's too early to comment on that.
And are these margins for this product will be similar to overall synthesis business?
Yes.
Okay. Thank you, sir. I will get back in the queue. Yeah.
Thank you.
Thank you. The next question is from the line of Dhruv Bhatia from Bank of India. Please go ahead.
Hi, good morning, sir. Thanks for
Dhruv, may I request you to speak a little louder through the handset, please?
Hello.
Thank
Am I audible now?
Yeah, you are audible now.
So my question is on the CDMO piece. So this quarter you've done about 577 crores of revenue. Is it fair to say that for the full year, this is at peak capacity utilization you're running at? So on a full year you could probably do 2,000 plus crores revenue from the segment?
We want to reserve answering this question right now.
But do you have the capacity to do further than this with current capacity available?
Well, capacity available, yes. Yeah.
Okay. And the 1,000 crores of incremental capex that you have planned for CDMO, what type of asset turns can we build in going forward?
You could take our current average is close to 1.5, asset turn 1.4, 1.5. Yeah. Yeah, between 1 and 1.5, depending on how we effectively utilize that capex. Yeah.
Understood. And the capacity that you've put up is obviously for, as you mentioned, the multi-year, multi-product contracts, but over and above.
Hello?
So the line for the participant dropped. We move to the next participant. The next question is from the line of Kunal from Carnelian Asset Management. Please go ahead.
Hello.
Kunal, you're not audible.
Hello, am I audible?
Yes, now you are.
Hi, this is Manoj here from Carnelian. First of all, congratulations for good set of numbers. I have a couple of questions. First one is on CDMO side. So just wanted to understand a little bit more on CDMO. Since you mentioned that you have built some new capabilities to build this business. So just wanted to understand two things, sir. A is like what is our right to win here? And secondly, how do you pen down the opportunity side in the segments where you are working?
The right to win these opportunities is based on reputation, regulatory track record, flexibility in offering volumes. That is the right to win. And the second question I couldn't get very clearly.
Sir, if you can pen down the opportunity size in terms of the segments or therapies or in terms of the molecules where we are working, where we are putting the capex. So if you can let us know the opportunity size overall for these segments where you are putting capex.
So in the CDMO, we have little or no scope to choose what we should get. So it all depends on what partner want us to make. See, we are not making we are not making cephalosporin penicillins. Other than that, we are offering a wide spectrum of things, starting from steroids, hormones, high protein, prostaglandins, so large volume, small volume. So our offering is very extensive, except cephalosporin penicillins.
Okay. And sir, whether these capacities which you are building are fungible, let's say if you are building a particular capacity, like you also mentioned in your PPT, that you are putting a capex on a multi-year contract, and let's say that molecule doesn't get the anticipated growth. So whatever capex you are putting, either it has to be protected by way of take or pay, or is it fungible? So if you can elaborate on this bit, sir.
One of the facility we are building is for a specific therapy area, animal health. Mm-hmm. So it is fungible within the animal health.
Okay.
Yeah, but not human health can put there. So that kind of fungibility is there. And other than that, other products are either advanced intermediates or APIs. Those are, there are some equipment technology specific which is not fungible, but majority of the reactors are fungible. Yeah. See, in the CDMO space, except few occasions, our partners don't use those vessels 365 days in a year. So some kind of flexibility has to be there.
Okay, got it, sir. And sir, one last question I have mainly on Laurus Bio. You mentioned that you are evaluating a plan to create close to 1 million liters fermentation capacity in phase 1. If that goes through, what kind of capex we can think for building this kind of capacity? And any color on timeline for this in terms of capex as well as ramp up?
See, we will get back to you on how much capex we are going to spend maybe in the next quarter or so. So we are finalizing our numbers. But we do expect this facility will up and running sometime during FY25.
FY25, and you see enough opportunity size for this in this space, right?
There are opportunities. See, the challenge right now is we don't have capacity to offer. So that is the reason we want to do this on a fast track mode, and we'll get back to you with the exact timelines and also how much we are going to spend on that.
But sir, on fermentation, I think world is over dependent on China, and still I think India is not there. So means building this kind of capacity. So if you can give us some color in terms of the kind of capability or the kind of I would say that means whether we will require some kind of pre-existing contracts or whether we will first build the capacity and then we have to wait for the contract. So some color on that, maybe means this quarter or next quarter. I think that will be helpful for us.
Sure. So this capacity is being built for synthetic biology, alternate foods, recombinant food proteins. So we are not competing with the conventional fermentation of steroids or vitamins or any other large molecules. So this is specifically for synthetic biology. Yeah, precision synthetic biology. Yeah.
Okay. Right, sir. Thanks for taking my question.
Thank you.
Thank you. Next question is from the line of Bharat from Quest for Value Capitals. Please go ahead.
Yeah. Hello. My question is to Dr. Chava. Sir, you said that you want to see CDMO to be 25% of the sales in FY25. And if you see our numbers now, already in last quarter, CDMO is 25% of the revenue, and this quarter it's already 37% of the revenue. So I would like to know, like, where do you see, CDMO in percentage of sales in FY25?
A very good observation. Maybe we have to revise our target to 1/3 by FY25. Yeah. From 25 to 1/3 by FY25, maybe.
Yeah. Because currently I can see in the PPT that it's 25% by FY25, but already you are 37%. So I think 33% is good number you see. Yeah. Okay. Thank you. And my next question is that total capacity of Unit 2 is 15 billion tablets.
10 billion.
And now, right now 10 billion is commissioned, but the total capacity, it can be estimated to 15 billion, right? You can also do a brownfield extension of 5 billion more, right?
Yeah, you are right. The physical infrastructure was created to expand capacity by 10 billion, but 5 billion capacity was installed and qualified. There is a room to expand by another 5 billion. That may happen next year, FY24, depending on how we are doing in Europe and US.
Okay. So you mean to say, like, once this 10 billion is completely utilized, then you will do a brownfield capacity of 5 billion?
Yes.
Okay. Thank you. And one more question is that in PPT you mentioned that you are taking calibrated tendering approach to ensure better profitability for this ARV formulations. So don't you think that you would lose market share because of this calibrated tendering approach?
See, what we meant by calibrated approach is we don't want to participate aggressively in tenders where winner takes all. So there people are very aggressive on the pricing. So we don't want to participate in those tenders, but still participate in tenders where the award is split among several people.
Okay. But generally, I mean, okay. But generally, I may be wrong, but I think this ARV tenders, it's not like winner takes all, right? It will be like 30% to the first guy and 30% to the second guy and 30% to the third guy. It will be distributed, right? It's not like winner takes all, I guess. Or I'm wrong.
There were some tenders, maybe I would put up to 10% of the market is winner takes all kind of situation. Yeah.
Okay. Yeah, thank you. And my last question is like, in last con call, you said, I mean, not last con call, I think 2 quarters back, you said that you are planning to use this Unit 4 capacity as interim to service this multi-year contract with animal health company till the dedicated plant is ready. May I know, like, by when you would be able to do commercial supplies from this interim capacities for this animal health company?
Commercial supplies will start end of FY24.
That's on the new capacity, new plant, right?
Yeah. So I think once the new capacity comes up, I think we don't want to utilize the capacity in Unit 4 for those products.
Okay. So you're not planning to commercialize in Unit 4, you're planning to commercialize only in the new plant?
You are right.
Okay. Thank you. Yeah, then that's it from my side.
Thank you. Next question is from the line of Pratik Kothari from Unique AMC. Please go ahead.
Hi, good morning, and thank you for the opportunity. There are a couple of questions regarding ARV. So in the last con call, we did mention that our API and formulation prices were down 10%, and you said this quarter it's down about 15% from high. So there's been further deterioration of 5%, correct?
Yes, and we do believe that's a new base. We don't expect further significant price drops. Yeah.
Fair enough. And we also did say that going forward in the coming few quarters, I mean, we used to do 550-600 crores of ARV APIs a quarter. We are at about 350 odd now, or rather 400 odd now. They should go back, but not at the same margins that we used to see maybe 2 years back.
ARVs, both the APIs and formulation put together, I think top line will grow, but at a lesser gross margin than what we enjoyed in the previous years.
Okay, fair enough. And so when you used to do, I mean, 2 years back when we used to do 550-600 crores of ARV APIs, that started a second line.
No, we never did 600 crores. So the peak we did was 1900 crore per year ARV APIs. But broadly you can say 1500-1600 crore APIs and another same number in the formulation. So our new yearly base for ARVs will hover around 3,000 crores. So it takes at least a couple of hundreds on the positive side. So that will be a new norm. So we don't expect that. See, the situation is evolving and we are accustomed, trying to accommodate to the changed environment. We are growing in volumes, but the price drops are pushing us downwards in our growth. So around 3,000 crore is the new base for ARVs put together. I think we are very confident to retain that number, and that number will also help us to retain our leadership position in both, especially in APIs.
So in your opinion, what is causing this price of, because at one time we also saw that our solvent prices, our input prices were going up and we were intending to pass that same. Has new players come in or has our market share changed in certain way? If you can throw some light.
It's a difficult one to answer. No new player came onto the market yet. Yeah. And it is not a growing market for 10 people to jump in. It is a declining market, and incumbents are very strong. If the incumbents are weak, then there is a scope for a new player, but incumbents are very strong and the market is stabilized, it is not growing. So it is a natural phenomena in the business So the era of high margins in this business has gone, and it has become a cash cow. So this is a very important segment for us at 3,000 crores, and it is important business for us. And we are committed to that business, and we do whatever course correction is needed to maintain our leadership position.
Certainly, sir. Thank you and all the best.
Thank you.
Thank you. Next question is from the line of Jeevan from Shahshar Capital.
Hello. Congratulations, sir. Just two questions. First is, last year when we talked, we were basically having world leadership in 8 molecules, and we are aspiring to go for 15 molecules. So where do we stand now?
In couple of oncology, we increased our market share. So that target is on given on that. So we are continuing to add portfolio where we have leadership position or ability to get to leadership position. That goal is on track, and in next 2 years, maybe that number, what you said, will definitely more than 10. Yeah.
Okay. Perfect. And on the CDMO side, basically we were into human health. Now we're getting into animal health. I think we'll also get into plant. So I think, looking at your CDMO, it looks like more of a chemical company than a pharma company. So and we have capacities, we have capabilities, we have credibility, and we have clients. So we have all 4 C's. So how do you see the traction coming in the CDMO? The kind of inquiries you are getting from the client. So are we looking to sign something similar, multi-product contract deal even in the future? So
we are not a chemical company. We are a chemistry company. So there is a lot of difference between that. So we intend to use our chemistry capabilities and scale to offer value to our partners. So I think we are adding more capabilities there, as I mentioned previously to one question. What is the right to win here? We offer large-scale chromatography, biocatalysis, fermentation, hydrogenation, continuous flow chemistry, very low temperature chemistry. So I think our capabilities are also very enhanced. We can also do spray drying. So because of those enhanced capabilities, coupled with our commitment to invest for a project, I think this division looks interesting for us. Yeah.
Okay, but so are you seeing similar kind of inquiries for a multi-year, multi-product deal? So large deal I'm seeing basically.
We are working on some. At an appropriate time, we'll let you know. Yeah, we are working on some.
Okay, perfect. And last question is on the bio side actually. So last time when we spoke, we said that we have enough land acquired for 3 to 4 million liter capacity. So right now,
we didn't acquire. We have chosen land parcels, and now we have zeroed in where to build. So we will close that land in this quarter, and then start putting bricks as quickly as possible. Yeah.
Perfect. And one more, sir, on the multi-year contract that we have for the CDMO. So is it for intermediates or also for API and formulation?
We can't answer that. Yeah.
Okay. Perfect. Thanks a lot, sir.
Thank you.
Thank you. Next question is from line of Naushad from Aditya Birla AMC. Please go ahead.
Hi, thanks for the opportunity. A few clarifications, sir. Firstly, on the capex pipeline of 2,500 crore, you mentioned 50% would go to CDMO business, and you have shared an asset turnover of 1.5x. Can you give us the asset turnover of the CDMO business, what one should expect?
I think when I mentioned around 1.1, 1.5, our CFO also corrected that. So you can take between 1 and 1.5. Yeah. Asset turnover ratio when it is fully utilized. See, the gestation between our cost to investment starts to getting to the peak commercial sale will take between 3 to 4 years. So that we invest and then we go to the peak, it doesn't happen. So the day we complete our capex, we need maybe another 2 years to fully utilize that capacity.
Yeah, that I understand, sir. So, in both the businesses, we should expect on a full utilization, it should give 1.5x.
Between 1 and 1.5, you are free to choose either 1 or 1.5.
Yeah. Okay. And how are we planning to fund this capex, sir? Would it be largely through internal accrual or any portion of debt we are planning for this?
I'll ask our CFO to answer.
Mostly internal accruals.
Okay. And by any chance, do you share your CDMO margin? If don't quantify it qualitatively, you indicate is this significantly higher than our API and formulation business or marginally higher?
We have been disclosing that on a gross margin side, CDMO is the highest, followed by formulation, followed by API. That is what disclosure we gave, and then it is still valid.
And at the EBITDA level, the difference remains same or it becomes narrow?
We don't calculate EBITDA level, so it's not possible to calculate EBITDA level.
Okay. And lastly, in our CDMO business, typically when we go for new client acquisition, what is our value proposition to the client? Is it cost? Is it the capability? What exactly we do or we pitch as a differentiation to get the client?
I think it's speed and flexibility.
Perfect. Thank you so much, sir, and all the best.
Thank you.
Thank you. I now hand the conference over to Dr. Satya for closing comments.
Thank you, participants, for your very intriguing questions. And we continue to update you any further information in the next calls. Thanks, Monish, for organizing this. Thank you, everyone.
Thank you, everyone.
Thank you very much. On behalf of Antique Stock Broking Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.